Hello and welcome to this week's Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith. And in this video, I am going to take a look at the condition of the overall markets as we always do and try and figure out whether or not the Qs here are going to hold this level of support. It's been a level of support earlier. Or whether or not this is really a rollover at a major level of resistance that could continue to go lower. So before I get into all that, as well as talk about different industry groups that are looking good and dragging the market down, I want to make sure that if you're just finding us on YouTube, that please subscribe to our channel. Also, you can find more videos like this at marketgauge.com/tutorials, as well as the text with this video. And finally, if you use Twitter, please follow us at MarketGauge and at Market Minute. And if you are not already seeing this video in HD, you'll like it much better. Just use the setting in the lower right-hand corner to do that. All right, so the reason I start with the Qs here is because the Qs are the worst looking index on a phase basis. And what I mean by that is that the blue line here is the 200-day moving average. The green line here is the blue line is the 50-day moving average, the green line is the 200, and the magenta line is the 10. And as you can see, the Qs broke through it last week, and then this week continued to slide lower. Now, Friday we had the jobs data, and as you can see by this chart, the jobs data managed to put in a really good test for the bulls, actually. We took out these three lows here, critical levels and levels from which the market could have easily slid significantly, but instead it wound up closing the day higher. Now, it wasn't a very easy day in terms of closing the day higher, and it wasn't a very violent reaction either. So going into next week, I think you really have to look at this boxed in area here, and then on the Qs really ultimately need to get back up above here. Now, we're sitting on pretty good support to justify a bounce higher, but we're going to take a look at the market internals. We're going to take a look at the industry group component of this, and even before we do that, we'll look at the easiest way to figure out in general which way the market's likely to go, which is to look at the market watch. So when I say market watch, for those of you who might be new to this, market watch refers to the fact that we look at the SPYs, the Qs, the Dow, or the diamonds, and the IWMs all together. Now, we want all of these things doing the same thing. Now, the really interesting part about where the markets are right now is that the Qs have led on the way down, breaking the 50-day moving average. However, the SPYs have just come back to their 50-day moving average, which is above their 200-day. The same thing is true of the Dow, and the same thing is true with respect to the 50-day moving average for the IWM. So this is the first trip back to the 50-day moving average since the February lows. And with the exception of the IWM, that pullback to the 50-day moving average comes above the 200. Now, that said, IWM has its own pretty significant level here, just to give you a review from some stuff that we've covered over the last couple weeks, and that is major trend line from the highs. Now, you could look at this as either a resistance level that has just held up, or a resistance level that's broken, and now this is kind of the last straw for this to hold up. Now, admittedly, this 115 level was a perfect place for this to fail and pull back, but that is all fine if you consider the fact that this 110 level is a good area for it to be holding its support, and this pullback has been much needed. We've needed a pullback in the Qs too, as we've had a really nice rally off the February lows without any real pullback. So this is a critical juncture. This week's going to be a critical week because in essence, if the markets slide lower than Friday's low, we're now entering a situation that the markets have not been in for quite some time, which is all of the 4 market watch charts back under the 50-day moving average. Right? We haven't seen that since the February break of the 50-day moving average, and we haven't seen that on the downside since the beginning of the year. All right, so let's take a look. I mean, the big picture here, just to review, for all of these, they all have their own range, but the range really is constructed by looking at the last several days of last week, and we can take a look at following the direction of the market in either direction. And the reason for that really comes when we start to look at the individual industry groups and the market internals. To sum it up before I go through the details, it's really quite mixed and could support a good argument either way. The one argument that really isn't there is that the market is severely oversold. All right, so let's take a look at why I'd say that. And I'm going to start by taking a look at the market internals, and then we'll circle back to the industry groups. All right, so I'm just going to look over here at our little big view section and find that under resources, little big view, and I'm at the sector summary right now. Now we're going to come back and talk about sectors and in the text of the outlook, which I haven't written as of doing this video, but my intention is to look at some earnings data that has come out from FactSet that looks at the industry groups as their earnings announcements have come out. And so we're going to take a look. You're going to see some of those groups that also show up here in the 3-month performance as some of the stronger groups. The trend as the market has been pulling back, however, has been, especially if you're following this chart down here, right, you can see the trend in terms of the number of industry groups that have maintained a positive 6-month percent change has been dropping. So this is a little concerning, and this supports the fact that if the market continues to slide, you don't want to pick a bottom thinking that this market is really strong. I don't think that the underpinnings of the market are very strong, but I don't think at this point it's conclusive that there isn't any support here. So we're really going to be relying on the price action. And we're going to take a look at the stronger groups a little bit later. So before we do that, let's take a look at the market internals. So if we start with the advanced declines in up-down volume, there's a very different story in the New York market versus the NASDAQ market. On advanced declines, they're not that different, but you will see it on the new highs and new lows. And the thing I want to bring to your attention, again, we're at the 50-day moving average. I apologize for the color change here. In this chart, the 50-day moving average is magenta. We pulled right back to that. The pullback has lasted about 2.5 weeks. We're also into support. So it's a small correction. And with that small correction, we have our 5-day up-down volume ratio down near oversold levels. We've got the McClellan near oversold levels. It's not a dramatic oversold. And so this is what I meant earlier when I said the market's not really that oversold. But it is at a level from which if the market starts to bounce, and this is how you want to read this. If the market sells off through here, the advanced decline numbers are weak enough to suggest that there's more weakness in the market, if that makes sense. Markets often collapse from weak areas. Example right here. If you were just looking at this indicator as oversold, it wouldn't have suggested oversold. All right. Even when this got down here, we were still here, and we had, that may not seem like a lot to go, but it certainly did feel like a lot to go when you were here, right? So markets will sell off from oversold levels. You want to make sure that the price action turns up. However, in strong markets, and I would argue this has been a strong rally, in strong markets, you won't get as oversold before you turn up. So you did turn up on Friday, but we want to see confirmation of the price action moving higher on Monday. All right. And if we do move lower on Monday, we don't want to take out the lows of this week. So once you start taking out the lows of this week, we're in more trouble. So McClellan down near oversold levels, but when it's low, when it's trending down, it's a negative. When it turns up from down here, it can turn into a positive. All right, the 10-day sum, same thing. The trend of this is still down. It's not oversold, but it has at least pulled back enough to allow the market to move higher without pushing against overbought resistance. All right, so the market, I guess in a short way to say it, the market's no longer overbought. It's pulled back nicely, but it is still pulling back until the price action actually moves higher above Monday's high. If we take a look at the same analysis with respect to NASDAQ, again, the issue with NASDAQ is that NASDAQ is much weaker on its moving averages. All right, so this is the one that's been leading to the downside. And yes, Friday, and this is the broader index, not the Qs. Friday had a positive day from open to close. And yes, this is at an area where it could be viewed as potentially oversold. I'm going to say it's oversold enough to justify a good bounce. All right, so if the market starts to rally next week, I think you can follow it cautiously, knowing that weakness could lead to more weakness. And part of the reason that I say that, it will be in actually the next chart. If we look at the new highs, this is actually one of the more surprising charts of the charts for me, because the new highs, the total number of new highs, and I talked about this last week in this very same video, and that is when this ratio is up here over this 90 level, right? Up over this, yes, that should be the 90 level, right? No, 85. When it's up over this 85 level, it is bullish. All right, now, in order for it to really be bullish, you really want your absolute number of new highs to be over 100. Now we've got both of those, and it's pulled back nicely to support, as we've talked about before, and the 50-day moving average. If I was only looking at this chart, I would be aggressively bullish. However, we're not just looking at this chart, but this is what a really bullish pullback looks like on this particular chart. The next chart, however, is almost the exact opposite. I call it the opposite because what you look for in a top on this chart is the ratio to have climbed over the 70 level and then start to roll over and price roll over with it. So in this case, price has broken through the 50 and the 200. The number of new highs in terms of the ratio is rolling over, and the absolute number of new highs never got over 100 and now is expanding on the downside. This is exactly what you do not want to see. So I would say it's unusual to see these two charts, both measuring the same thing on different markets, be so dramatically different. So this is the reason, this is a primary reason why I am saying if the market moves lower, you really do need to get out of the way, expect more weakness. However, the other half of the equation is the bounce off the 50 with 3 out of the 4 MarketWatch charts at their 50 seems like a logical place to find support, not to mention that the Qs are at a good support level too. How far it goes up if it bounces, well, we'll track that as it makes its progress. And really, which indexes to follow as they move higher is also going to be a really big component, I think, of being able to trade this market the best way possible. So from a sentiment point of view, I was last week talking about the fact that the VIX has based out here and had the potential to potentially break out to the upside, and that would be a big negative. It didn't happen, And in fact, things have kind of turned. So it's come up now to the higher end of a range and started to turn back. This 50-day moving average on the VIX, while I won't say is always great support, when it demonstrates, great resistance or support, inflection point, when it demonstrates itself to be an inflection point, you want to look at it. And so if the market continues higher, this is likely to drop, and it will have demonstrated itself as an inflection point. Now, what we really prefer to see from a more convincing time frame or convincing signal is to see the VIX get through the Bollinger Band on the upside or the downside. It hasn't done that. So for this chart, this is kind of a lukewarm indication that perhaps it's rolling over at resistance, which would just suggest, to me doesn't suggest any more than the market could be okay with the decline and willing to at least let itself start to bounce. Nothing in terms of sentiment has really been wrung out there. Didn't mean to click on that, sorry. I meant to click on the final chart here, the volatility ratio. And this is also one that led me to be a little bit more concerned last week with if we were to break the low of the week, we could get going to the downside, because when this rolls over, you then establish a trend. And just much like I would argue that once it really started to roll over here, you can get the market going. Now, this can stay high for a long time. And as long as it's high and kind of moving higher, all we can say here is it's the sentiment's a little frothy, or you could say a little too complacent. But until that really breaks, sentiment can last a lot longer than you think. So the thing to watch out for, I think this is a really easy indicator to read. Don't read too much into it if it's trending higher, other than the fact that when it finally relieves itself to the downside, it can be more serious. But we could be much, much higher before that happens. If it breaks this level and is trending lower, watch out. Okay, so until then, just kind of keep your eye on it, updates every day. So from a market internals point of view, I think you can hopefully see why I think the perspective right now is the market has sold off. You need some weakness to get a good sell-off to buy the bounce, but good weakness, if it breaks a key inflection point, is the point at which we see hard sell-offs. We're at that inflection point now. It's the 50-day moving average in all these charts and many more, and that's why it's such a critical level. So depending on your point of view, whether you prefer to be long or prefer to be short, the opportunity here for the long traders is you've got a really tight stop. If your stop is under the 50-day moving average, at least in a bias point of view. And for the short traders, as soon as this thing starts to roll over, it's going to be probably your time to really play. And as we rally, unless this market picks up steam, it's probably going to be a weak attempt to break these highs. That said, we'll cover that when we get there. So let's take a look at the market watch with our new indicator, the real motion indicator. I introduced this, or Keith introduced this as well, over the past couple weeks. We've really gotten some great response from it, so I'm glad for all of you who have discovered this and are liking it. Let's just take a quick look at how it works and what we're looking for, and I'll go through it quickly. So basically, the real motion indicator here is a form of a momentum indicator where the dots equal a one-day measure. The blue line is a 50-day measure. The green line is a 200-day measure. And then you just compare that. The easiest way to use it is compare it to what's going on in a price. And oftentimes it will lead, sometimes it will diverge, and sometimes it will just confirm. So in this case, and this is the case with a lot of the charts, when you've got the price coming down to the 50 and your real motion also coming down to the 50, and they both have the same formation, it's basically just confirming what's going on. And from my point of view, it's really not telling you much that the price isn't already telling you, except that you know the momentum is in sync with the price. So that is information in and of itself. It's not a buy signal. It's not a sell signal. So if we look at all the markets that way, we can see that the SPYs are kind of the SPYs are just confirming. The Dow down here just confirming, doing the same thing. The thing that was concerning, continues to be concerning, right, is that the Qs broke the 50, and so did the momentum. So the momentum was confirming everything that the Qs were doing. A better situation for the bulls would have been that the Qs didn't break and stayed up here while the price may have slipped. Right now, the one interesting thing here is that oftentimes momentum levels serve as support, and so we are down at support with the momentum levels as well. Lower end of the Bollinger Band, yeah, that can be too, but I would call that less significant than the other measures. Now, the strength of this argument is in the IWMs. And one of the ways you can see that this momentum was key was this trend line, because you can also do trend lines with real motion, and you can see that the real motion trend line from the highs in the market was broken down in here. So IWMs really have been a leader in terms of their real motion momentum, and they continue to be. So you can see that this has not pulled back all the way to the 50. The 50 and 200 have crossed in IWM. They have not crossed in price. So momentum is still in good shape on IWMs. So from a real motion point of view, we've got the Qs that are leading on the downside and momentum is confirming. IWMs, which are holding up really well, and momentum is gaining, is the bullish side of this argument. And if you think about that, it is the large cap techs versus the smaller cap general market index. The smaller cap general market index has been the laggard for years. And so is that now going to shift its roles? If it does, maybe that's what this market needs in order to continue these rolling bull and bear markets. I'm not going to suggest it means we launch into another major bull market yet, but you'll see it on the momentum and you'll see it in the price if and when it breaks out. Now, a big component of what's going on also is the TLTs, or interest rates. Until this week, interest rates really looked like they were rolling over. Falling TLT prices means higher interest rates. However, they held this support. You can see the momentum in this case was breaking down before the TLTs actually broke down, so it was no surprise to see the TLTs break pretty hard when they did. I have to admit, I'm pretty surprised that after this action here, TLTs have gotten back up through this resistance. But when the market does something I don't really expect it to do, it puts me on a heightened alert. And this too is an indication and a place to be looking this week. If the equities start to sell off, look here to see whether or not there's fear and a flight to safety. It's because the momentum here is still not breaking and confirming the break. However, if the markets break higher, I would expect the momentum to break higher, and then everything will be in gear. All right, a couple of dots like this, not that significant to fight if the price trend continues higher. The value of the two dots still being under the 50 is that if the market heads higher and this starts to sell off, TLTs could have a really significant move to the downside. All right, now that means TLTs, and if you read Mish's Daily or you're a member of Mish's premium services, for which I'm also substituting this week, you'll see me having said this. TLTs are set up for a potentially large move this week in either direction. I'd expect the up direction to occur if the stocks are selling off. I'd expect the down direction to occur if the stocks are rallying. So keep an eye on TLTs. I'd also put this trend line in a much neater way. We haven't broken it yet, but I'd put that in. And the big picture is really this. All right, this thing is setting up for a significant move. I would actually say a move of this size in either direction. It would not surprise me 4 or 5 weeks out to see the TLTs at new highs. It would not surprise me to see them right here. It would surprise me to see them right here. All right, so and that will have an impact, if not more, at least psychological, on the equities. Now, crude or oil has been a big component to the rally, whether it's literally pushing the stocks higher or just emotionally helping the stocks higher. The low in crude is the same day the stocks bottomed out as well. So I think it's important to keep an eye on it. Now, on a longer term basis here, you can see that the momentum in crude actually has shifted to the positive. And here's another example where this is kind of pulled back a little bit, but momentum has not pulled back here. So I would read this as follows. And I'll show you this in another chart in a second. The shorter term momentum is a little weaker. So if this does pull back to the 50 on a bigger time frame basis, that's going to look like a good area for support and expect it to hold. If it breaks to the upside, the momentum is still very much in gear here, and I'd expect it to go to the upside. So this is not precise enough. This particular reading, 50 and 200, is not precise enough to say which way the next couple days will go out of this. But if it's down, it'll probably find support. If it's up, it'll probably rally. It could easily rally pretty substantially, which would be, at least as it has been, a positive for stocks. But these correlations shift frequently. All right, so let's just take a look at a little broader group in terms of industry groups in the same view. So if we take a look at the modern family, as Mish puts it, the 6 different charts that she uses to really drive her take on which way the market's going to go, we have some interesting things going on here. So it's just starting with the XRT, and we've got some more retail earnings coming out this week, so this could have a big impact on it. But the interesting thing here is that it broke through this significant low here. The real motion on a moving average basis is diverging. It's much stronger than it is on a price. However, on the daily value, it's essentially confirming the down move. So this divergence is great when the prices are holding support, but when the prices stop holding support and the daily value breaks down too, you got to follow the price. This is just pretty much confirming what we see. It will come into play if XRT comes back through here and starts showing some significant strength to the upside, and then the momentum gets going before the price does, and then we'd expect that this trend line here would break, and it would be a significant head fake here. All right, but we can't say that that's the case quite yet. On IBB, everything that's happening in price is being confirmed by momentum. As I said earlier, sometimes you can find resistance, support and resistance in momentum. Momentum found resistance at that 200 period level, and that was the same time that the IBBs topped out there. So IBBs, they still need time to bake. IWM we've already looked at. This is the bullish side of the market. SMH, momentum's doing, real motion's doing the same exact thing as the price, so there's not much that's encouraging there, and SMH is sitting right at this 200, but it doesn't look like it's in any condition to be much of a leader. That said, if it breaks out nicely over the 200, we can start worrying about it. The interesting chart here, I think, is transportation. So transportation has what looks like a nice looking double bottom on a real motion chart that is running stronger than the price, right? So the real motion chart is ahead of the price chart, and IYT has pulled back significantly through its 50-day moving average, and the real motion has held it. Now, by itself, as I said, that would not be all that compelling. Combine it, however, with the fact that we took out this low by a tick and rallied. If we can get back up over the 200 and even more interesting, back up over the 50, all this is going to look like a nice bottom of a range of a component of the market that had led the market higher. All right. That said, the best looking component of all of these are actually the financials. So Mish looks at the KRE in the modern family. You can see that this is pulled right back to the 50, which is also good support here. The real motion is still holding over or right at its 200. So any move to the upside, and this is likely to pop higher and look better. And I'm just going to give you XLF in here too, because XLF looks even better. You can see how the real motion is crossing. The daily level hasn't even come back down towards the 50. Everything's stronger on momentum than is on price, and that's an example of real motion leading price. So if there's an area, here's a scenario. I don't remember if I said this in last week's video. I've said it to some of our members. One of the scenarios that I'm watching very closely is TLTs start selling off in a significant way and XLF start rallying. That's the relationship. Higher interest rates should help XLF, and it doesn't always, but if the price action in XLF is positive and the price action in TLT is negative, that's a relationship that I want to be involved in trading. And this momentum is telling you both of the momentums are really pointing to that becoming a reality. So I'm just waiting for price to confirm on that. And the first step of that really would be XLFs to break back over the 50, TLTs to break down, XLF break back over the 200, TLTs to break back down under their 50, and I think XLFs could really start to provide some good trades as well as the underlying stocks there. All right, so we're almost done here, but we also have the triple play. And the triple play view of the world here, let's just take a look at it from the XRT point of view, is looking at whether or not XRT is a leader in the market, not the momentum, but a leader. And also here's the price leadership, here's the volume leadership. And simply the 1 day measure of that is the blue line, a longer term period of that is the red line. So if the blue is over the red, it's improving. If it's under, it's getting worse. Again, you want to see the same thing happening with the price. What you don't want to see happen is what you see here, which is the XRTs rally up and they don't pick up any leadership and then they start falling apart, and you've got triple play confirming the fact that it's negative and it continues to slide. So that's how you basically read the chart. You can see that this picked up the XRT as being one of the first places to look for on the long side. So if we just take a look at all the modern family with this viewpoint, you can see very quickly by looking blue versus red that XRT not looking for a turnaround, IBB not ready for a turnaround, IYT close. You know, maybe we'll take a look at this on a shorter term basis because I think it's turning up on a shorter term basis. IWM, nothing extraordinary there. And again, KRE, while not perfect, not positive, it's the strongest one. It'll turn around the quickest. Let's take a look at XLF. Same thing, will turn around the quickest. All right, so if we take a look now to just conclude at some individual industry groups on a little bit of a more granular level. So on this chart, I have the triple play look for the longer term, which we were just looking, the daily. And then we look at triple play also on the half an hour to see, sometimes you can see it turning up. And here's the real motion on the longer term daily, and here it is on a quicker daily, where we're looking at a 50-day moving average and a 10-day magenta moving average. We're looking at that relationship on real motion. And again, sometimes you can see the markets that may not look so great right now, turning up on the short term. And I think, if I remember correctly, IYT is one of those. So yeah, so IYT, remember, this is the one that I think is particularly interesting if it can hold this low. So on the triple play, it's slightly negative on the daily, right? On the longer term, slightly negative. We want to see the blues over the reds. But on the half hour, it turned up on Friday nicely, and they don't always do this. So this is an indication that if it can continue to turn up on Monday, for those more nimble traders who want to have a tight stop under these lows, there's an opportunity there. And even if you're not trading this one, it could be a place to look for some strength in the market. And again, part of the reason to look for that or expect that would be that you had that real motion holding up better on the daily. However, on the shorter term real motion, the breakdown of this 50 here is very much confirmed by real motion. In fact, the real motion was diverging below it before the breakdown. So this is why I would say if this breaks down from here, you really do not want to be sticking around to hope it's going to hold, because it could easily fall pretty hard. Now, when if we look at some of the stronger industries in terms of their groups, the materials was one of the best, has been one of the best performing groups in terms of earnings announcements versus expectations, and they've also been one of the stronger groups over the last 3 months in terms of price action. And if we just check them out in terms of how it's looking, because this is an area you might look to if the market turns higher. So XLBs on triple play are, I'm going to say, pulled back nicely to the red line, so that's okay. Wouldn't be too concerned with the volume crossing if the price goes up, only if the price continues to go down. And on a shorter term basis, the turn up began on Friday here. All right, so, and actually I should say on a volume basis began on Thursday, which often happens. Friday, the price action kicks in. Now, this is a slower moving component of the market, so if the market really takes off, this measure might slow down a little. But you can see didn't even make it to the 50, sitting on support. XLB, good place to be looking. And on a momentum basis, it's holding up just as well on long term. On short term, got to be a little bit worried if the price continues to pull back, but that's kind of what we've been saying about everything. There isn't anything in the market right now that I wouldn't say get out of the way if the market starts to head lower. But there are certain places I would look first on the upside, XLB being one of them, XLF, KRE being others, as we've already mentioned. So XLP, I put this was actually my blog post on Monday. One of the things to keep an eye on in this market is XLP. As long as this keeps chugging higher, I think it's telling you that the market's not ready to give up on itself yet, but be really careful if this one starts to take a face plant along with the rest of the market. If part of the market is strong and this starts to sell off, that wouldn't surprise me either. It would actually represent, I think, a shift from the feeling of safety over here in consumer staples to maybe a little bit more risk. But XLP area, the consumer staples, is one of the areas that has had good or better than the rest of the sector performance in its earnings announcements. And from a triple play point of view, it's running ahead of the market. So this is the leader right now from a momentum point of view. Everything's being confirmed on the longer term, not necessarily running ahead, but confirmed. And on the shorter term view, it's got some work to do down here with it back. Remember, in this case, we're looking at the relationship between the blue and the magenta. So it's over the magenta. This is my concern, as I just said. If it starts to roll over, be really careful, because on a short-term basis in here, real motion, it is starting to lag. Now, if we look at XLY, and these are all the ones that were good in terms of the earnings data. XLY looks, I would say, really good on the triple play relative to the rest of the market. it looks supportive or confirming on the longer term real motion, and again weak on the shorter term real motion. But all in all, this is one that has held up well. Now, this is heavily weighted by Amazon, so be wary of that. That said, if this starts to head higher, if the market starts to head higher, if Amazon continues to move higher, this is an ETF I would continue to watch to move higher. And finally, we'll finish it up with healthcare, and get to these again because they were the ones that were the stronger ones on the earnings. And you can see that is not healthcare, that is silver. And we can look at that from a health. So the healthcare situation here is that it's pulled back. It's under the 200. It's at the 50. This is not one of the stronger looking charts. And on triple play, it's certainly not the stronger looking chart. On Friday, it wasn't a stronger looking chart. So I'd be careful with this one. And really would not focus on it until it starts to move higher. The only positive here is that the real motion is still positive, but it's really just kind of confirming what's going on here. Slight divergence developing, but the divergences you want to see aren't 1 or 2 days. You want to see them over several days or even weeks. So that's still pretty premature at this point, and the short term here is negative too. So we've got 3 out of 4 that are somewhat negative, and price action just sitting on the 50. I think there's other places to look. All right, so again, 40 minutes. Try to make these things faster, but there's so much to pack in. But I think now you can see the thinking and the logic and where to go look. Different areas of the market to take advantage of what's going on right now. And I'll conclude with, if you have not already seen the free training on the opening range and being able to time the market intraday and really understand why the market turned around on Friday, and how you could have anticipated that turnaround on Friday, please check that out. Should see some email in your inbox about how to trade with the opening range, and that will only be available through the weekend. Have a wonderful weekend, and best of luck with your trading next week.